Well, thank you very much, and hello everyone. Thanks for joining us today. As mentioned, I'm going to basically spend about the next 15 minutes taking a look at the big picture view before handing it over to Robert for the regional drill down. I have to say, when we look at the overall uh, picture of the economy, this is one of the more complex economic environments certainly I've seen in my career. We've been dealing with extremely high inflation, a very sharp backup in interest rates. There's all kinds of, frankly, talk about an outright downturn for the Canadian and the global economy in 2023. So that's a lot to unpack. Let's get started with a very big picture view of financial markets in 2022, and frankly, it's been a tough year for financial markets. If we start with what really triggered a lot of the concerns. Of course, it does go back to inflation, and much of that relates to the sharp run up in energy prices that we had at the start of the year, partly, of course, as a result of Russia's invasion of Ukraine. I do want to just step aside for a moment, though, and just drive home the point that we had a very serious inflation episode on our hands even before Russia's invasion of Ukraine. If you go back to February, we were looking at a US inflation rate of roughly 8% and a Canadian inflation rate of 6%. That's not terribly different from where we are today. And in fact, if you look at that chart on the left-hand side of oil prices, you see that, as we speak today, oil prices are actually somewhat lower than they were before Russia's invasion of Ukraine. And it's not just oil prices. If we look at a broad basket of commodity prices, most are actually a little bit lower than they were back in February. So we can't really pin this all on Russia's invasion of Ukraine. We've got a much broader inflation episode that we're dealing with, and as a result of that, central banks have come roaring off the sidelines. And raise interest rates at a pace that, frankly, we haven't seen in decades. Now, I've just picked one interest rate here, the 10-year U.S. government bond yield. Just as a reminder, that yield started the year at about 1.5%. As we speak today, it's closer to 4%. That is an enormous move in a short period of time. And there are many, many interest rates that I can point to that have risen much more than that run up in the 10-year yield. Meanwhile, up until recently, we've had the US dollar just steamrolling over every currency in the world. First against the yen, then the European currencies, and in the last couple of months against the Canadian dollar. And the reason why this is important is that's leading to a double whammy of inflation pressures for the rest of the world. So when you think of economies like Japan, Britain, Europe, Canada, we had our own domestic inflation pressures. And then on top of that, we've been dealing with a weak currency, which means we've been importing inflation pressures from the US. Now, in recent weeks, the US dollar does look at it like it has come back a bit. It has come down a little bit. The Canadian dollar's made a bit of a comeback. But again, the bigger picture here is that the US dollar is generally strengthened against all currencies. Now, when we add all these things together, an energy price shock earlier this year, a big backup in interest rates, a strong US dollar against almost all currencies, well, that's been a real problem for equity markets as a whole. Again, we've seen some recovery, an encouraging recovery in recent weeks in equity markets. But I think the big picture is, not just in the U.S. but globally, we're looking at a pretty severe downturn for equity since the start of the year. So when you add those conditions up, we've had a big rise in interest rates, weakness in equity markets. That certainly does point to cloudy weather ahead for the global economy and the North American economy. We'll start with a big picture with the global outlook. If you look at that table in the middle of this chart, you can see we've got the global economy going from a nice rebound last year of 6% to 3% growth this year, and then a bit of a further cool down in 2023. Now, to us, a normal year, quote, normal year for the global economy would be growth of about 3.25% to 3.5%. So we're a little bit below what I would view as an average year for the global economy in 2022. And I have to say, I consider that to be a big disappointment, because when you think about it, we came into this year believing that we were going to have an above average year for the global economy as tourism reopened, as entertainment reopened, travel got back to normal. We thought we'd have a fairly strong year for the global economy, and we did get that reopening in tourism and entertainment. But unfortunately, we also had two big draws on the global economy. One is that China the second largest economy in the world, dealt with a rolling series of lockdowns, That led to growth of about half of what we were expecting in China, and then the rest of the world was dealing with that very big backup in interest rates and high inflation, and that clipped consumer spending almost everywhere else. Now, looking into 2023, we do see a further slowdown. We think that that backup in interest rates will bite down a little bit more deeply on global growth, and so we see the global economy slowing to just a little bit more than 2%. Our view is that anytime the global economy dips below 2% growth, we would call that a global recession. So we're just a little bit shy of a recession. However, I do think that one more negative shock, would tip global growth into an outright downturn in 2023. That's a very big picture view. Let's drill down to North America. What do we see for Canada and the US? Starting with Canada, when we look at this year, this will actually end up being a fairly strong year for the Canadian economy. It looks like growth will be about 3.25% this year. A normal year for the Canadian economy is something closer to 2% or maybe even a little bit less than that. So we are looking at a fairly solid year for the Canadian economy. And a lot of that just goes back to the fact that we did get the reopening in Canada. We did get that big rebound in tourism and entertainment. On top of that, it now looks like we had a very strong rebound in the grain crop in Western Canada after the terrible drought in 2021. And also the big bounce in commodity prices at the start of the year did support a number of key regional economies in Canada this year. Now, relative to the U.S., there are a couple advantages that we had over the U.S. In this year. One is we had a reopening this year. I would suggest that the U.S. really reopened last year. For all intents and purposes, COVID was almost over, at least in their view, in 2020. So our reopening happened a little bit later. Also, the relative strength of commodities did support Canada more than the U.S. So those were two big relative advantages and why Canada grew faster than the U.S. in 2022. Unfortunately, both those relative advantages are now fading. The reopening has basically happened. As I mentioned earlier, commodity prices have come down from those strong highs we saw earlier this year. And meanwhile, we've got a relative negative that's starting to move to the forefront. And that relative negative is the size of the housing sector in the Canadian economy. When you think of you add together renovation activity, new building activity, and real estate agent fees, those account for a little bit more than 7% of the Canadian economy. In the US, when you add those three things up, it's about 3.5% of the US economy. So housing is about twice as important to our economy as it is to the US economy. Thus, when housing is going into reverse, as it fairly clearly is, that's a much bigger drag on the Canadian economy. So we've got two advantages that are now fading and one negative that's moving to the forefront. And that's why we see both the Canadian and US economies basically moving in sync in 2023. Our view is that we are likely looking at a shallow recession for Canada and the US. And in the next year, we actually see an outright decline in GDP in both economies in the first half of the year before a small recovery through the second half. And when you tally that together, it looks like we're essentially looking at no growth in Canada and the U.S. over the year ahead. Now, that's not to say there aren't some positives. And by the way, I don't think a downturn is locked in stone. I think there is still a narrow path by which the economy could avoid an outright downturn. I think that still is a possibility if a lot of things went right. However, I also think there's the risk that we could see a more severe downturn than the shallow recession that we're officially projecting. One positive I would point to, there's no question, we're still looking at one of the tightest job markets, one of the healthiest job markets that we have seen in generations. For instance, we just heard recently that Canada added more than 100,000 jobs in the month of October. That kept the unemployment rate at just 5.2%. That's one of the lowest jobless rates that we have seen since the early 1970s. In the US, arguably the job market is even tighter. Even with a small increase recently, the U.S. is also looking at an unemployment rate of just a little bit above 3.5%. That's one of the lowest jobless rates they've seen since the late 1960s. And this is not just a North American story. If you look at that table on the right-hand side, you can see, many major economies are looking at one of the lowest jobless rates that they've seen in many decades. In almost all cases, they've now got a lower jobless rate than they had before the pandemic. And if anything, the job market is even tighter than that headline unemployment rate would tell us. On top of that, there are also many job openings. In the U.S., there's almost 11 million open jobs. In Canada, there's almost 1 million vacant jobs. And right now we have about 1 million people unemployed, so we effectively have one open job for every unemployed person. I've never seen that before. That to me is the very definition of full employment. If you think that's tight, it's even tighter in the US, where they have almost two vacant jobs for every unemployed American. As I said, that's one of the tightest job markets we've seen in generations. Now, as a result of that, naturally, we're beginning to see a lot of wage pressure on both sides of the border. It really began in the U.S. earlier. They saw a tighter job market earlier than we did, and they're starting to see some sustained upward pressure on wages. There's lots of different measures of wages. The ones we look at suggest that the average worker in the US is now seeing wage gains on the order of about 6 to 7%. That's strong, no question about it, but it's actually a little bit below headline inflation. The latest inflation reading came in at close to 8%. In Canada, we're also seeing some upward pressure on wages depending on which wage measure you look at. The typical Canadian worker is seeing a wage gain of about 5%. Again, that's a solid number, one of the better gains that we've seen in quite some time. But headline inflation is around 7% now. So the average worker is trailing, far behind inflation. So take those two elements together. We've got on the one side one of the strongest, healthiest job markets that we've seen in generations on the one side. And on the other side, we've got wages that are actually trailing behind headline inflation. To me, that's the very recipe for labor market unrest or strife or conflict. And that's exactly what we're beginning to see. We're beginning to see strike activity, public sector and private sector workers agitating for bigger wage increases. Perfectly understandable, given the fact that it is such a healthy job market and their wages have been trailing behind inflation. And when we look back at the long sweep of history, the chart on the left looks at headline inflation in Canada and the US going back to 1960. The only episode where we really had serious labor market strike activity in North America was during the 1970s and early 1980s when we had very high inflation. Now, there's a lot of information on this chart, but a couple things I would point to is, first of all, you very rarely see much separation between Canadian and U.S. headline inflation. In other words, where the U.S. leads, Canada does tend to follow. We really can't tend to do a whole lot better than the U.S. In the last year, we have done somewhat better than the U.S. As you can see from the table on the right-hand side, or the bar chart on the right-hand side. Canada is at the lower end of the spectrum and globally when we look at inflation. But again, this is a very uncomfortably high inflation rate that we're looking at. Now, looking over the next year, the chart on the left-hand side does look like we've got inflation coming down and coming down very fast in the next 18 months. And we do have inflation backing off from these extraordinarily high levels that we're dealing with right now. However, we still expect inflation to average almost 5% in Canada and the US next year. And by the end of 2023, we've still got inflation in the 3.5 to 4% zone. That is just too high for central bank comfort in the year ahead, even with considerable improvement over the next year. Now, let's just stand back for a minute and take a look at what has caused this inflation. How did we go from years and years of 1.5 to 2% inflation to roughly 7% inflation now in Canada? And on the right-hand side, we're taking a look at, what's in the consumer price basket of goods and services, what's gone up the most in price in the last 12 months. And frankly, I think there's 5 different stories here. There are 5 different themes that have driven inflation to the level we've reached. And very briefly, one is energy prices. So you see natural gas and gasoline prices have gone up a lot. Second is the reopening play. Last year, no one was traveling. This year, everyone was traveling. So that's pushed up hotel rates and airfares from very, very low rates. Third story is the supply chain issue we've all heard a lot about. So we've seen pressure on things like furniture and appliance prices. Fourth is the global food crisis. You can see grocery prices have gone up by double digits. That is not a Canadian story. We're seeing double-digit increases in grocery prices almost everywhere. And story number 5 was the housing boom that we went through. Now, home prices don't enter directly into the basket. They enter sort of indirectly through real estate agent fees, new home prices, and rent. But a home price boom does work its way into the consumer price basket. And so my main message to you is there are 5 different things that have caused this inflation burst. That's 5 things that have got to stop going wrong or even start going right over the next year. Frankly, there isn't just one light switch that policymakers can flick off and make inflation go away. We need a lot of things to stop going wrong. And that's one of the reasons why central banks have been so aggressive in raising interest rates over the past year. They're trying to avoid this buildup of inflation from getting what they call entrenched or locked in, and changing consumer psychology on a sustained basis. And that's why they're being so aggressive in terms of the rate hikes. Now, Mr. Macklem recently indicated that not that the end is near, but the end is getting within sight. We still believe that the Bank of Canada is likely to raise interest rates by a total of another 75 basis points, or 3/4 of a percentage point from here. Our official call is another half-point increase at their next meeting in December, and then another quarter-point hike in early 2023. And then we see them holding interest rates through 2023 at that level. If you think back to our inflation forecast, we still have inflation around 3.5% by the end of next year. So that's why we think rate cuts are more a story for the year after. We think that's a story for 2024. Meanwhile, in the U.S., we think they've got a little bit even further to go. The Fed has now leapfrogged the Bank of Canada a little bit. They've hiked rates by a quarter point more than the Bank of Canada. We see another full percentage point of interest rate increases from the Federal Reserve. We do think they'll slow down to a half-point increase at their next meeting in December, but then we see two more rate hikes in 2023, lifting the U.S. interest rates a little bit further above Bank of Canada interest rates in the year ahead. Now, you may be wondering, well, if you've got U.S. interest rates going up by more than Canadian interest rates, isn't that going to put a lot of downward pressure on the Canadian dollar? And the short answer is yes, but I would assert that that has already been built into the Canadian dollar. This is the main reason why the Canadian dollar weakened so much in late August and September and early October, is because the financial markets were building in this view that U.S. interest rates would go up by more than Canadian interest rates in the year ahead, and that's why the Canadian dollar did sag specifically against the U.S. dollar. Now, as you can see from this chart, the old standing relationship between the Canadian dollar and oil prices, which worked like a charm for about 15 years, really has gone astray in 2022. The dominant story, the dominant driver of the Canadian dollar over this past year has been the flip side of the US dollar itself. So in other words, as the US dollar was rising against everybody, that's what steamrolled the Canadian dollar this year. Our view is that the US dollar is close to a peak, if not already there, and will tend to lose a little bit of altitude in 2023 against all currencies. And so the flip side of that is we do see the Canadian dollar making a little bit of a comeback next year. Don't get me wrong, we don't see a big backup in the Canadian dollar, but our core view is that the Canadian dollar is currently a little bit below what we would consider to be fair value, and we do see it somewhat strengthening over the year ahead. That's it for the big picture view. I'm now going to hand the baton off to my colleague Robert Kavchik to give you a drill down to the regional view.